Welcome back. Well, we've heard from the governor himself, keeping rates unchanged as expected at 8.25%. And still with me to unpack this decision is PwC Economist Xhanti Payi and lead economist at KPMG, Frank Blackmore. Frank, Xhanti, thanks so much for joining us again. Let's start there. Let's start with your initial reactions to, the Sarb keeping rates unchanged. I think something that was interesting here is that 4 members preferred for a pause and 2 preferred for a cut. Let's get your initial reactions, Xhanti.
Yeah, look, I think that's something that's, I guess, suggests some positivity in terms of the outlook, that there is perhaps some momentum in the changing of the stance of the Monetary Policy Committee. But I thought that one of the things that was ironic is that, he talks about the resilience of the developed markets and and so, of course, high employment rates in those markets as a reason why, of course, inflation has remained elevated. And, of course, as I say, ironically, it's the same reason that is for which we need lower interest rates. So the people who are competing with are doing much better than us. And their conditions, their good fortune is something that's actually holding us down in the sense that we can't really stay competitive if we're to cut rates in pursuit of the same kind of, employment and growth. So it is something that's quite ironic in terms of what the global world is facing. But certainly it speaks to, again, what he signaled around the reforms that are necessary to get to that place, to get to the place where actually our economic activity becomes resilient, that we actually start to cut unemployment. So it's something that's quite important for me as I was listening. I thought that was something that's quite ironic, and really that speaks to the reforms that are necessary for us to get to where these nations that we're competing with in terms of interest rates are.
You're absolutely right about that, Xhanti. I mean, when you look at that US labor market, those numbers that come out month on month, you see very, very resilient. Frank, let's get to you, your initial reactions. Would you say that Governor Lesetja Kganyago was a bit dovish this time around?
Yes, I think so. I think, remember, in our pre-conversation, pre-announcement sort of conversation, we said we must listen out for perhaps some indication of what the future may bring. And when he introduced the May inflation number at 5.2, he did say this was unchanged from April, but with an improved outlook. And he said the expectation of the bank was for headline to dip below that 5% level because of reasons of declining food and fuel prices, and core to remain close to the 4.5%. So I think that's one of the first times that we've heard sort of a forward-looking type of view that was more dovish than we've heard in the past, although no change. And as he always says, it will be data-dependent, and that the bank is obviously committed to stabilizing inflation over the long term and sustainably. I think those are always two sort of riders that he puts to any of the statements of the Monetary Policy Committee.
Sticking with that inflation outlook, yes, some comments around improvement, but he did say that, the risks to inflation have moved from balanced to the upside yet again. What have you made of that, Xhanti?
Look, I think actually also he mentions why, and the big thing being these administered prices. Again, when we were talking pre the announcement that Eskom continues to obviously request those higher than inflation increases, and that's something that he's quite concerned about when he talks about administered prices. He really reflects on that. We also know, I think, that municipalities, even though they've been denied, many of them have been denied these increases because they didn't do those hearings that they were supposed to do before they increase administered prices. That speaks to water, that speaks to the services they provide. That's something that they're going to go back to. And then come back and actually implement those increases. So certainly administered prices are a big risk to the upside for this, and that's something, of course, of great concern. But it still remains to be seen, of course, because the regulator will still preside over the final outcome on that. But certainly, we know that we are going to see increases that probably will push that number up.
Frank, we talk about this improved outlook. Yes, risks are still to the upside. But do you, with what the governor has said today, do we still expect to see some rate cuts this year?
Yes, I still think we do expect for some rate cuts this year towards the end of the year, and I think that's what the governor was trying to sort of communicate to the public. Basically, is although there are these upside risks, if we don't see those risks, the trend is towards a decline in inflation over the rest of this year and into next year, which would signal the opportunity for rate cuts by end of year.
Xhanti, you know, there's been mixed bets with some pegging a cut in September, some pegging a cut in November. Where are you at on that front?
I think we are more later in the year when we've seen much of these things coming through. So certainly there's still, as you say, as he says, there's a lot of this coming through. But also remember, one of the key things is that anchoring of expectations. So inflation expectations. So when people actually start to be convinced that inflation is coming down, and that's a really key thing, is that they look at in terms of, and he said that those expectations are coming down. So I think once they see that the expectations have come down sufficiently, will they actually start to say, and I think one of the things therefore we have to look at is to say, look, let's wait a little bit towards the end of the year when actually the interest rates coming down, and then the expectations of people also have come down. The market expectations of inflation have also come down. Will we actually be able to see that? So certainly later than sooner.
Xhanti, I was hoping you would, look into your crystal ball and give us, that guess, maybe September, maybe November. The Sarb has maintained that they are going to be very data dependent, of course, looking at that inflation number and the trajectory of where it's going. It's been, it's proven to be quite difficult to tame. And we've had the governor talk about lowering that inflation target over the past few months, saying it'll make South Africa a bit more competitive. Frank, just talk us through the risks associated with doing that right now, because he did mention that he wants it to be done before 2025.
Yeah, so the timing is perhaps unfortunate at the moment, given that globally a lot of the inflation is caused by global factors, and a lot obviously we also have our fair share of local factors. So basically globally inflation is high, but for many different reasons. We know what our reasons are. As Xhanti has said, there have been inefficiencies in the network industries, the administrative prices, public debt's been high, etc., etc. So I think his longer term forecast is to reduce the inflation rate. Obviously that's good for all South Africans because it preserves the value of our incomes and our wealth, our savings, etc., over a long period of time. It doesn't get, taken out by the inflationary effect. But to get it there, if you can imagine, currently the interest rates are restrictive, and that's to get us to 4.5%. If we have to go further down, let's say to 3.5%, we'd have to keep the same level of restrictive rates just for longer. So as long as the economy is restrictive, people don't go out and spend, businesses don't invest, and that creates this subdued effect on economic activity, decreases aggregate demand, and slowly lowers that inflation rate. But if you do that while the whole world's inflated, that's going to be quite a tough brief. So I think that's why we don't hear too much of it in these MPC meetings, even though we know it's on the long-term agenda. I think he will focus on, let's get us to 4.5. Then we look at how the world looks. When we're at long-term interest rates that are sustainable at that level, perhaps then we target the next step in the process.
All right. So, Xhanti, I just want us to take a look at the global picture for a minute. We have the what is this? The Trump, rather. We have this whole market expecting a Trump victory come November, just after what had happened over the past weekend and after he had just announced he's a VP candidate. How much of a risk is this for emerging markets in particular?
Well, on the upside, Trump, in his first term, was not particularly very interested in emerging markets like Africa. If you look at his stance, for example, calling us all sorts of names, but also that he didn't spend a lot of time bringing ambassadors to Africa, so it was sort of something at the back of his mind. But we also don't know, though, that the U.S. Congress has changed somewhat in terms of its stance. And one of the things that we probably we should be thinking about is what kind of Congress actually comes out when Trump wins the election later in the year. And that Congress will probably be one that perhaps maybe a little bit harsher, given what we are seeing. I mean, Congress at the moment, U.S. Congress is looking to review their relationship with South Africa. That is something, of course, that could be devastating for us, depending on how that review goes. So the Trump presidency is probably one that is something that is scary in some detail, or one that could actually, where things could just go on the way that things had happened in the last cycle. But I think one has to be very concerned about the Congress that Trump would bring with him if he wins at the end of the year, and that's something that many of us should be concerned about if we are thinking about the important economic relations we share with the United States.
So, Frank, it could be business as usual, or things could change. What are your thoughts around, the Trump victory that could come in November?
Well, the two main aspects that we must consider. Internally in the US, it'll probably be good. We saw when he came to office the first time, there were tax cuts, stimulated the economy. So if your business and yourself are heavily weighted to sort of US, you may benefit from the outcome. We also saw then his foreign policy was kind of where people took exception, both with his view to places like Africa, but Asia as well, etc. And there we don't know what's on the agenda currently. So as long as he sticks to his domestic policy, we may even benefit through stimulation of the US economy, may mean more demand for African goods and services, and that would be good for us. I think also we've changed our political sort of landscape as well since the last time he was in office, where there were a lot of critics of what the government was doing at the time, perhaps moving towards the east from the west, the whole that sort of whole geopolitical shift. Well, I think that's less likely to take place now under a government of national unity with the various parties sort of grouping together. We're about to hear the president's opening of parliament, and there I think he will specify what's on the agenda for the GNU over the next few years. And I think it will be more like his inauguration speech, unite, try and focus on growth, etc. And all those things are positive indicators to the rest of the world.
You're absolutely right. We also have the Minister of Trade, Industry and Competition heading over to the US next week just to, chat US-SA relations and everything connected with AGOA. We also have the Fed meeting this month. As we mentioned in the conversation prior to Lesetja Kganyago making his announcement on keeping rates on hold, we've had the Fed quite dovish. We've had commentary from Powell, really, really dovish. But, we've also seen growth quite strong. We've also seen that labor market quite resilient, even though inflation is slowing. On the US front, when do you see those rates coming through? So, Xhanti, I really want you to look into your crystal ball and, just give us that guess.
Look, we saw deflation in the US in April, quite something that is quite interesting. Now, if you're looking at prices that are actually declining, then naturally you will see that interest rate cut coming up. But as we know, that the US economy looks very, very set to grow. And interesting that Frank says, the US under Trump performs better because it will cut interest rates and it may cut taxes, and you see more left in the hands of the rich who actually do spend. And that's something, of course, that could continue to keep a bullish economy and a bullish consumer. And that's not a good thing for interest rates.
Yes.
In the US. So that kind of expectation, but also is interesting because obviously one of the things that we heard from Trump saying that, he wants Powell not to touch those interest rates because it would look like he is supporting Biden. But of course, they're not political. They would try and be neutral in terms of how they determine. So the US has a better chance now of and still better chance of a growing economy. It's not like their cutting is still very, very thin in terms of what they will do to actually those possibilities are still thin because the inflation in the US is still robust and the expectations of that, if we think about a Trump presidency, are robust. So they would be very concerned about cutting, even though there seems to be that downtick. That continues to be a challenge for all of us.
Gents, unfortunately, we have to leave it there. Thanks so much for joining us today and just sharing your analysis on, the latest rates decision. That was economist at PwC Xhanti and lead economist at KPMG, Frank Blackmore.